AIM-listed First Property Group, which has exposure to commercial property here in the UK and also in Poland and Romania, it swung back to a profit before tax of £7 million after a loss last year of around £5 million. It's also back to paying a dividend after the hiatus last year, including the interim dividend. This works out at half a penny per share. Ben Habib is the chief executive. He joins us now on the line. Ben, welcome. Certainly the market response this morning has been good to the numbers out today. The stock is up in what is otherwise a falling market. So clearly there's an appreciation of what's gone on over the last year. And I know part of what's been seen in terms of the benefit has been some sort of reorganization of the balance sheet in Poland. Explain more about what's been going on and how good business is.
Yeah, so the real story, I think, for the last year is a balance sheet story. It's not really an income story. And that's because even though profits are up from a loss of 5 million the year before to 7 million this year, that's really come from renegotiating the terms of a loan that was secured on a property in Gdynia, Podolska Street in Gdynia, where a lease to a major tenant was coming up during the course of the pandemic. We actually agreed terms with that tenant to renew the lease, but it required about 3 million euros of fit-out costs. And when we went to the bank to get their consent to put the new lease in place, they dragged their heels over the fear that the First Property Group wouldn't be able to or may not put the 3 million up that was required, and that would become a burden for the bank. And because they took so long, the tenant left. Can you imagine losing a significant tenant for an office in the teeth of lockdowns? That was, they were gold dust. And so that was a real setback for the property. And having damaged the value of the property dramatically by failing to agree to that new tenancy that we'd negotiated, the value of the property fell, and we negotiated a reduction in debt. And the debt had been 26 million euros. We renegotiated a reduction to 16 million euros, of which we repaid 4. And it was that reduction in debt from 26 to 16 that drove our profits. But that's really the story there is really a balance sheet issue. It's a balance sheet benefit because we've now seriously reduced our debt levels. Our total debt is about 23 million, 35% LTV, net debt at 17 million, which is very small compared to the value of our properties, which are in excess of 42 million.
You say it's a balance sheet story, which accounted for what happened mostly last year. But of course, the business itself is split into two areas. It's split into fund management and it's split into the property division. How has this year started? Where do you see the business part of the operation going?
Well, we're going to be very opportunistic going forward. The investment markets are on their heels. Let's not make any bones about that. There's a kind of investor absence at the moment as inflation takes root and interest rates are going up and people fear recession in the United Kingdom. Recession is unlikely in Poland, but there is nevertheless a investor standoff. And that creates opportunities for a firm like us because we can sort out and find those gems, which typically would go to bigger, richer investors that would just outbid us. But in this market, we become quite an attractive buyer of assets that we wouldn't normally get exposure to. So we're going to be looking out for those special deals, mostly offices. We'll be looking carefully at Warsaw, carefully at the Tri-City area of northern Poland, which includes Gdynia, and also selected secondary locations in the United Kingdom. That's where we're going to be focusing our attention.
And what about the fund management part of the business? What's the contribution from that? Because I think you've now got something like 13 funds under ownership, haven't you?
Yeah, we have. And we raised a new fund during the year, which I should mention, forthcoming Property LP, which is an open-ended fund. And we had anticipated we'd be, ramping that up to 100 million under management quite quickly. But it's Japanese money, it's open-ended. Whilst there was an indication that it would ramp up to 100 million, it wasn't committed. And with this investor, withdrawal from markets because of what's happening at the macroeconomic level, the money hasn't come through in the way that we had hoped. We've invested 10 million on their behalf, but that should grow over time. But all these deals that I mentioned, these opportunistic deals that we might do in Warsaw, Tri-City region and secondary cities in the United Kingdom, all of those we would seek to do through fund structures. So we would go to investors whom we know well, who trust us, on the same page with us, philosophically, if you like. and try and get as much sensible debt against these properties that we can, marry investor demand with our debt, and then go out and buy these properties. It will no doubt mean that we can't offer top dollar, but we don't want to offer top dollar. We want to buy these properties well.
Let's pick up on that point as well about macroeconomic, because it is important to work our way through what's happening. As we know very well here, we've got interest rate rises coming through now from the Bank of England. We had 5 in total, 5 quarter-point rises. Expectations are we're going to see inflation now at 11% by the end of the year. How would you normally expect, under normal sort of economic conditions, we've got inflation at those elevated levels, how would you normally expect to be appreciated as an investment? Because we hear a lot about this idea that in order to hedge against inflation, you need to be owning assets of some sort. And of course, property is an asset class, which in the UK especially, we appreciate for what it is. So under normal circumstances, I guess you would probably be in a pretty good position. But at the same time, we've got the consumer falling apart, which technically speaking underpins the whole economy.
Yeah, so I mean, this happens in phases, doesn't it, Jeremy? It's not an instant thing. And the first phase of this has been a supply side breakdown, an acceleration of costs. And that has actually increased building costs, not by the 9.1% headline inflation rate that you hear about. It's doubled building costs, okay? Make no bones about it. Building costs have gone through the roof. And that has brought new supply to a crashing halt. So there's virtually no new developments going to be considered. There may be some that come through because they were planned and they'd broken ground before this inflationary spiral. But there will be an absence of new development. Now we're having the second phase of this inflationary spike, which is secondary round inflation through wage increases. And we saw Mersey Rail yesterday get a 7% increase in their wages. Eurostar, I think, got 8%, London Underground 8%, and Docklands got a staggering 9%. The teachers' unions are now claiming an 11% increase in wages. And all of that, which when it comes through, and it will come through, I think, is going to then lead to demand side inflation. And at that point, property begins to recover quite quickly, because once you get demand back in the economy and you've got an absence of new supply of property, rents have to go up. And when rents go up, people who own properties obviously do well. And that's how the hedge works. But of course, it's not all sunny uplands, because the central banks will react again to that secondary round of inflation. And you may see more rapid increases in interest rates, which may then cause another collapse. So I think we're in very uncertain times. But one thing you can be certain of, and that is that rents for commercial property, offices, irrespective of working from home, are going to go up in the next 12 to 24 months.
To what degree as well do you think, because I've seen on some areas of reporting that Brexit has been behind some of the higher levels of inflation than we're seeing in other countries? Now, I speak to you, as I know, as someone that advocated Brexit as an opportunity. Yeah. Now, here we are now. Do you attribute a sort of a margin of inflation to Brexit? Do you think that's a fair assessment?
No, I don't think that's fair. I mean, inflation, supply chains across the developed economy were broken by lockdown. And, gas reserves were depleted, oil reserves were depleted, manufacturing facilities were put on hold. There was a complete demand shock when we locked, economies down. And when we unlocked, what the government needed to do, and people say, well, hindsight's a great thing, but actually I did say it at the time. When we unlocked, what we needed to do was reduce the burden on consumers by reducing taxes such as VAT, for example, tax on fuel. The government had to take that hit. It didn't take that hit. And the British government is perhaps more at fault than many others, because we came into this crisis, this cost of living crisis, already with the cost of living very high. We all remember that wage growth in the UK has been pretty stagnant for the last 12 years. We had a bit of wage growth just before the pandemic kicked off, but actually it's been, close to non-existent. So we've had increasing costs for 12 years with not much wage growth. And that's really the problem with the United Kingdom. I don't think it's Brexit. It's a government that hasn't really got an ideology, doesn't understand how to drive the economy for growth, is wed to the last ideology that it's heard from the last person that's been in the Prime Minister's office. And they pivot all over the place. What they need to do, or what they needed to do, I think it's too late actually, Jeremy, but what they needed to do was to get ahead of the problem and cut VAT, cut national insurance, not increase it, cut corporation tax rate, not increase it. We've got the highest tax rate in 70 years. We've doubled national debt under this Tory government. And GDP, here's a figure. It's staggering. Take this figure away with you. GDP in the UK is about £2.2 trillion. It was £2 trillion when the Conservatives took over in 2010. In dollar terms, GDP per capita hasn't moved in 12 years. That's under a Conservative government. If you don't have growth, and this has got nothing to do with Brexit, if you don't have growth and you have increasing costs, your economy is going to come under real pressure. And that's what we've got.
And of course, as a businessman, you see that firsthand. Let me move away from Brexit and the political difficulties that some may perceive them as they are at the moment. Let me move back into the workings of the company, because I wanted to focus, if I can now, on a quick discussion around what's happening in Eastern Europe. You've got Polish exposure, as you've indicated, and that is obviously clearly doing well and clearly contributing to the bottom line in quite spectacular form. You've also got exposure to Romania. Now, these are two countries which are rather close geographically to the heat of the action at the moment between Russia and Ukraine. And indeed, of course, Poland has seen a lot of migration into the country. With exposure to Poland, how do you feel about what's happening and where things are likely to go?
Well, war isn't always an entirely negative thing for those who are in or around it. Obviously, it's terrible for Ukraine, but Poland has been a beneficiary of this war. It has taken in 2.4 million refugees. They're culturally, very similar to Polish people. So they've been absorbed very easily and have joined the workforce. They brought money with them. Ukrainian businesses have relocated from Ukraine to Poland to find a safe haven. Poland, by the way, has taken more refugees than any other Central Eastern European country from Ukraine. And what we're seeing actually is quite a demand created in the economy by these refugees, and they're buoying the Polish economy in a way that we don't have the luxury of in Western Europe. So Poland is actually a beneficiary of the war at the moment, and I expect that to continue. I don't think many of some will go back to Ukraine, but not many will. A lot of them will stay in Poland, and that's terrific for a country that had an otherwise mature population of around 38 million. This is young, Ukrainian, hardworking, well-educated, culturally similar people coming into the country and contributing. So I think we're going to see a strong Polish economy going forward, and we're going to see demand for commercial property coming through from that and other sources. Poland isn't going to go into recession like we are. And I suspect rents on commercial property are going to go up quite more dramatically in Poland than they will over here, even though I expect them to go up here as well.
Yeah, and I would just like to say at this point, we did discuss this before we went to air in this interview, and I know that you are, like me, massively concerned about the dreadful, needless, tragic loss of life and circumstance for so many people.
Yeah, and we've done a lot, by the way, to help refugees. Just on that point, we've been housing refugees in our properties and stuff as they've come through from Ukraine. So, everyone's pulled together in that effort to help Ukraine.
Yeah. Absolutely. Can I shift the focus onto Romania? What's happening there? I know it's a smaller part of the two of your Eastern European exposure. What's going on in Romania? You happy there? You're going to carry on?
It's been a very good experience for us, Romania, but we're going to sell our properties and exit the market. It's a very thin market. On average, Poland turns over somewhere between 5 and 7 billion euros worth of property a year. Romania turns over $1 billion. It's a fraction of the size of Poland. And we believe in having on-the-ground management and hands-on kind of approach to our properties. So unless we could build up a portfolio, it didn't really make sense for us to continue there. So we're selling our properties there. We anticipate selling them on, prices well above book value, which is cost. And, we'll recycle that cash into Poland.
One final question. Let's bring it all together. And you started this current fiscal year. Let me just quickly ask what the trajectory is for this year. What's the most pressing thing for you this year as a chief executive to ensure investors get a return. Let me just quickly bring up the share price actually to bring this into sort of context, because the share price is actually, this goes back to 2013 or so, and you can see here the COVID lows on the sort of right-hand side-ish of the chart. We're not actually too far away from there, but at 31 pence a share, I know that you are you're discounted by about 30-odd%, aren't you, to property value?
Yeah, so our adjusted net asset value, taking properties at market value, is about 47 pence a share. We're trading, I think, last I looked, at 30p a share, which is a 37% discount, which is huge. And I mean, that's basically saying the market thinks property values are going to drop. But I've just been telling you all the reasons why I think actually rents are going to go up. And investment yields may be hit a bit as interest rates rise. Yields will move out. So you'd see yields having a depressing effect perhaps on property. But if rents double, which is far from, that's a realistic possibility in the next 12 to 24 months. That's not me being far-fetched. If rents double, you're seeing a significant increase in the value of property. So I don't see much threat to our NAV where we are at the moment. This is a kind of rock bottom net asset value per share. And so I think that discount is not merited, personally. And I think it's easy money, frankly, at the moment, buying First Property Group shares.
I have to say that is a big if, isn't it? I mean, that's a big increase and a big burden for people who's already got a bottom line that's been hit hard by the recent financial difficulties. You are happy for us to go on record and talk about that and talk next year about how you see things have developed, doubling rents?
Yeah, absolutely. I mean, the way we're going to make money this year, Jeremy, is selling our Romanian properties, selling some supermarkets in Poland, recycling that cash into new properties and new sort of fund vehicles, buying property, and then doing more of that as we go through the year. So you'll see us actively trading. And if we're successful in that active trading, you will see, I think, our NAV automatically floating up together with the rent increases that I anticipate. And do please make a note of this and challenge me on it next year.
I certainly will. Look, Ben, thanks so much indeed for your time. It's a pleasure being able to catch up with you and taking a look at this market where we are at the moment. That's Ben Habib. He's the Chief Executive of First Property Group. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.